Hey there, everyone! Welcome back to our channel. If you're new here, I'm so glad you found us. Today, we're diving into a fundamental concept in the world of investing, liquidity. Now, I know that sounds like a fancy financial term, but don't worry. By the end of this video, you'll not only understand what liquidity means, but also why it matters in your investment journey. So, grab a seat and let's get started. Before we get into the nitty-gritty, let me ask you a question. Have you ever tried to sell something, maybe an old video game or a bicycle, and realized it wasn't as easy to find a buyer as you thought? That's a bit like liquidity in investing. So, what exactly is liquidity? At its core, liquidity refers to how quickly and easily an asset can be converted into cash without significantly affecting its price. Think of cash itself, it's the most liquid asset out there. You can use it to buy just about anything, anytime. Now, let's break this down further with some examples. Imagine you have three types of assets: cash, stocks, and real estate. Cash is the king of liquidity, it's ready to use the moment you need it. Stocks, on the other hand, are quite liquid as well. If you own shares of a company, you can sell them on the stock market almost instantly, often within seconds. The price might fluctuate a bit, but generally, you can convert those stocks into cash quite easily. Now, let's talk about real estate. Selling a house can take weeks or even months, and during that time, the property's value could change. This makes real estate a less liquid asset compared to cash or stocks. You see, liquidity exists on a spectrum. At one end, we have highly liquid assets like cash and stocks, and at the other end, we have illiquid assets like real estate, collectibles, and certain bonds. But here's the kicker: different investments come with varying degrees of liquidity. For example, a rare collectible might take months to sell, and you might have to lower your asking price just to attract buyers. This leads to the concept of liquidity risk, which is the risk that you won't be able to sell an asset quickly enough without losing money. Let's put this into a real-world context. Picture this: you've invested in a startup company that's rapidly gaining traction. The potential for high returns is exciting, but here's the catch: your investment is tied up in shares that you can't sell until the company goes public or gets acquired. If you need cash urgently, say for a medical expense, you might find yourself in a tight spot. This is the liquidity risk we mentioned earlier. Now, you might be wondering how liquidity affects your investment strategy. A good rule of thumb is to maintain a balance. If you have all your money tied up in illiquid assets, you might struggle to access cash when you need it most. This is why many financial advisors recommend keeping a portion of your portfolio in liquid assets. According to a 2021 report by the Federal Reserve, about 40% of US households would struggle to cover a $400 emergency expense. This highlights the importance of having liquid assets available. In your investment strategy, consider a mix of liquid and illiquid options. This way, you can aim for growth while still having access to cash when life throws you a curveball. So, to summarize what we've covered today, liquidity refers to how easily an asset can be converted into cash. It ranges from highly liquid assets like cash and stocks to less liquid assets like real estate and collectibles. Understanding liquidity helps you manage your investments effectively and avoid unnecessary risks. Now, I'd love to hear from you. What assets do you have in your portfolio, and how do you manage their liquidity? Let us know in the comments below. And if you found this video helpful, don't forget to hit that like button and subscribe for more educational content on investing. Thanks for watching, and remember, investing is a journey. Make sure you're prepared for both the highs and the lows.